All right, if you're an aspiring analyst, maybe you're just about to step onto the banking floor for the first time, this is for you. We're going to break down the entire complex world of investment banking into something you can actually use. So let's just get right into it.
Okay, so here's our game plan. First, we're going to tackle the big one, investment versus commercial banking. Then we'll peek inside the bank itself, see how it's all put together. After that, we'll look at the two main moneymakers, advisory and trading. We'll also get into the super important compliance wall, walk through a real-life IPO from start to finish, and finally, we'll talk about where you, the analyst, fit into this whole massive ecosystem.
All right, let's start with the absolute fundamentals. You really have to get this first distinction, because it's all about a simple question. Where does the money come from, and where does it go?
So here's the fundamental difference. Think about your local bank branch. That's a commercial bank. You put your money in, they take those deposits, and then they loan that money out to other people. Simple, right? Well, investment banks don't do that. They don't take deposits. Instead, they live in the capital markets, the world of stocks and bonds. They're basically professional matchmakers, connecting companies that need cash with the investors who have that cash to spend.
Okay, so now we know what an investment bank does in the big picture. Let's zoom in a little bit and see how the machine itself is actually built. It's not just one giant room of people yelling into phones, it's really three very distinct, very separate parts. You can really think of the bank as having three specialized teams. You've got the front office. These are the people on the front lines, the ones bringing in the revenue. We're talking about your classic investment bankers and traders. Then you have the middle office. Think of them as the referees, the ones managing all the risk and making sure everyone's following the rules. And finally, you have the back office. This is the engine room. They handle every single operation that keeps the lights on and the whole bank running smoothly. So why do you, as a new analyst, need to care about this structure? Because this separation of duties is everything. It's the bedrock of the entire firm, it's what prevents catastrophic errors, it's what creates the checks and balances that regulators absolutely demand, and it lets everyone become a true expert at what they do. So let's focus on that front office for a minute, the heart of the bank. We're going to break down the two main ways it actually generates all that revenue that, pays for everything and everyone else.
And that's the big question, isn't it? Where does all this money actually come from? Well, it really boils down to two very different but equally critical ways of doing business.
So on one hand, you've got fee-based advisory. This is all about playing the long game, big strategic projects. And on the other hand, you have the lightning-fast world of trading. A big part of that is something called market making, which just means the bank is always ready to buy or sell. They make their money on the tiny difference between those buy and sell prices. It's called the spread.
Now, when most people hear investment banking, this is probably what they're picturing, the advisory side. This is where the massive, headline-grabbing deals happen, like one company buying another in a merger. It's also where you'll find the teams that guide a private company through the whole crazy process of an IPO. These are long-term, high-stakes projects.
Then you've got the other side of the house, the trading floor. Their main job is market making. Basically, they provide liquidity, which is a fancy way of saying they make it easy for big investors to buy or sell, because the bank is always there to take the other side of the trade. Of course, they also execute trades for clients. And historically, banks would trade their own money, so-called prop trading, but that's been massively restricted since the financial crisis in 2008.
This brings us to probably one of the most important concepts you will ever learn as a new analyst: the separation between the advisory side and the trading side. It's not just a polite suggestion, it's a fortress wall, and it is mandated by law.
It's officially called an information barrier, but you'll almost certainly hear people call it the Chinese wall. The whole point of it is to stop private, sensitive information from the advisory side, like, say, a secret merger that's about to happen, from leaking over to the trading side. It's the thing that prevents illegal insider trading, and it is taken incredibly seriously.
And this whole thing has been a real regulatory roller coaster. Back in 1933, the Glass-Steagall Act put up the first big wall. Then, in 1999, that wall got torn down, and you started seeing these giant financial supermarkets. But after the 2008 crisis, the pendulum swung back hard. New rules like Dodd-Frank came in and rebuilt those walls to get risk under control. So here's the bottom line for you as an analyst, and I can't stress this enough. Understanding and respecting these barriers is completely non-negotiable. Breaking these rules isn't just a slap on the wrist. We're talking about serious, career-ending consequences. Your entire future in this industry depends on it.
Okay, so let's make this all feel a bit more real. A great way to see how all these different pieces, advisory, sales, compliance, the back office, all have to work together is by looking at the anatomy of an initial public offering, or an IPO.
Trust me, an IPO is a marathon, not a sprint. First, the advisory team spends months, sometimes years, getting the company ready and doing insane amounts of due diligence. Then comes all the legal paperwork with regulators like the SEC. After that, the sales team goes on a roadshow to get investors excited, and only then do they finally set the price, hand out the shares, and the company officially goes public. It is a massive team effort.
This quote really just nails the bank's role in all of this. During an IPO, the bank is the expert in the middle. It's the facilitator. It connects the company that's hungry for capital with the investors who are looking to provide it. The bank doesn't buy all the shares for itself, it manages the entire process so that the transaction can happen smoothly.
All right, so we've mapped out the entire bank and all of its functions. Now let's bring this all back home. Let's talk about you. How does this structure actually impact your career path? And yes, how much you get paid?
Look, it's no big secret that pay in banking is directly tied to how close you are to the revenue and the risk. The front office, the team bringing in the deals and the trading profits, has by far the highest earning potential. The middle and back offices are paid differently, but make no mistake, they are absolutely essential. Without them, the front office couldn't even function for a single day.
And that really brings us to the end. We've laid out the structure, the jobs, the rules, and the rewards. The world of investment banking, it's a complex, incredibly high-stakes ecosystem. But now you have the map. You have the analyst's guide. So the only real question left is, where are you going to make your mark?